The past year has been nothing short of a tug-of-war, fought between global headwinds and domestic resilience, persistent FII outflows and strong DII inflows, and tariff pressures against reform-driven growth initiatives. This push and pull shaped market movements, with the first half witnessing correction and the second half seeing a meaningful recovery. Even a cursory look at the Nifty 50 Index one-year chart perfectly reflects this. Concerns around US GDP growth and a softening jobs market have raised the probability of Fed rate cuts, creating a supportive backdrop for risk assets. Rising long-term yields across major economies, excluding US, with a widening 30 to 10-year spread is concerning, and it could weigh on capital flows into EMs and valuations. The INR has been the weakest among EM peers against USD, pressured by tariffs and sustained FII outflows. Domestically, India's real GDP grew at a healthy 7.8% in Q1 FY26, though nominal growth slowed to 8.8%, the lowest in 3 quarters due to low GDP deflator. The government has reinforced policy support through GST rate cuts and simplification measures. These cuts are likely to have multiple positive spillover effects on the overall economy. Furthermore, by lowering inflation, they should provide the RBI with the necessary headroom to act. According to preliminary estimates, these measures may add 0.3 to 0.5% to GDP and lower inflation by 0.2 to 0.3%, while increasing the fiscal deficit by approximately 0.2%. Valuations also present an interesting setup. MSCI India's valuation premium to MSCI EM has dropped below its 10-year average as MSCI India has underperformed MSCI EM by approx 3% CAGR on 3-year rolling basis. Global funds remain significantly underallocated to India at a 20-year low, leaving ample room for inflows if sentiments improve. The temperature gauge index remains in the fair value zone. Global equities remain resilient near highs despite tariffs and geopolitical risks. Expectations of a Fed rate cut offered some support, while ongoing conflicts in Europe, South China Sea and Russia-Ukraine kept markets volatile. On the domestic front, the US tariffs have come into effect on select Indian exports and may have a multi-layered impact, including potential slowdown in economic growth. Amid slowdown concerns, Government of India has taken actions by cutting GST rates to revive the demand. This, coupled with transmission of rate cuts by RBI, higher disposable income due to tax savings, benign inflation outlook and rural demand revival, are likely to offset the tariff impact and provide boost to the growth. Indian markets have turned volatile due to FII's outflows of approx 30,000 crore in August, however strong domestic inflows provided stability. Global funds are underweight on India, and any positive momentum build up in economy and earnings may change this sharply. Further, cash available with domestic MFs may provide support in case of sharp correction. Nifty index is trading around historical average on 1-year forward basis. However, mid and small caps remain at elevated premiums, warranting caution and selectivity. While markets are going through this tug-of-war between domestic tailwinds and global uncertainty in the short term, we remain positive on the long-term India growth story and hence equity markets. Equity allocation stance continue to remain neutral, with exposure of 65% to large cap and 35% to mid-small. Investment strategy. Lump sum investments in hybrid funds at current levels. For pure equity-oriented strategies, a staggered SIP/STP approach is prudent given elevated valuations and higher volatility. Any sharp correction should be used for aggressive deployment. In fixed income, the yield curve has bear steepened, with long-term yields rising more than short-term. Higher SDL borrowings, fiscal consolidation worries, lower chances of policy easing, and pressure from currency weakness are the factors behind such move. We continue to favor accrual strategies across the credit spectrum, along with income-generating assets. Accrual can be played across the credit spectrum by allocating 45% to 55% of the portfolio to performing credit and private credit strategies. Select InvITs, REITs, NCDs. 30% to 35% may be invested in performing credit strategies, NCDs, and select InvITs, REITs. 20% to 25% may be invested in private credit including real estate, infrastructure strategies and select NCDs. 25% to 35% of the portfolio may be invested in arbitrage funds, minimum 3 months holding period, floating rate funds, 9 to 12 months holding period, absolute return long-short strategies, minimum 12 to 15 months holding period, income plus arbitrage fund of funds, minimum 2-year holding period. For tax-efficient fixed income alternative solutions, 20% to 25% of the portfolio may be allocated in conservative equity savings funds, minimum 3 years holding period. We continue to maintain a neutral stance on gold from asset allocation perspective. Recent rally in silver has been more spectacular, delivering approx 30% in the last 3 months. While silver may move higher on the back of buying in precious metals, expectations of revival in industrial demand etc., current levels do not present attractive risk-reward.